Liquidity should be thought about in terms of what is the actual alternative mutual fund investing in, what is under the hood of that alternative mutual fund. And you have to look at it in terms of asset class. So for example, equities tend to be more liquid than credit. So to the extent that an alternative strategy is investing in credit, it will probably be less liquid than an alternative strategy that invests in equities. However, alternative mutual funds have to follow the same liquidity rules that every other mutual fund does. So there's a 15% limit on illiquid securities that's defined by the SEC, and alternative mutual funds have to follow this same rule. Liquidity does vary over time though. So for example, in 2008, everything was less liquid than we thought it was, and that could happen again. And so far we haven't actually seen a reason to be worried about illiquidity in liquid alternatives. However, to the extent that there may be liquidity issues in credit, that should be something that investors should look at. Liquidity varies cross-sectionally across an asset class as well. So for example, within the S&P 500, there are less liquid stocks and there are more liquid stocks. Within credit, there are less liquid credit and more liquid credit. And so for example, a hedge fund that doesn't have the liquidity limits constrained by the 40 Act can invest in any type of credit, and over time you may get a premium or an alpha from investing in that type of credit that you might not see in a mutual fund. But then if there's a liquidity crunch, then the mutual fund might outperform in that scenario.